So today, actually, we're going to be covering a few things. I decided to kind of split this session up, and it's going to be more around the kind of the life of the loan, the process of a loan, just so that some of you guys, probably understand this just by working a file, but just to give some more formality to it. Okay, so I'm going to start off with this. Does anyone here know what are the potential and the required upfront borrower fees, and how many of them are there? I know we're kind of lacking a larger group of loan officers today. Some we have in jury duty, some have appointments, but for those that are on here, do you guys know all the out-of-pocket cost a borrower or borrowers can incur from really within the first day or two of application, or definitely pre-approval and then right into escrow?
You mean like a credit check or like
Okay.
all
Yeah.
that?
So that's one, right? So you guys send out a link, and typically, right, the process is going to be the borrower is going to pay for the credit. You know how much it is per borrower?
$120. I forget.
108. Guys, these are things you guys should really know and jot. Okay, so take notes. It's $108 per borrower, or borrowers plural if they are married. Okay, so any other additional co-borrower that's gonna be added, a brother, sister, friend, whatever, aunt, uncle, mom, and dad, that's an additional $108. Yes, it does. They are generally paying for, unless you're going to be a generous loan officer and you cover that for them. Okay, in which these fees that we discuss right now, you can collect through closing on your commission. Okay, through your commission payout, it is something that you can collect back, right? Because you're going to charge it to the borrower. You'll pay it up front, but you can collect it at closing. What's another fee?
Appraisal.
Said that, Paul. Yes. So appraisal. So those are the first two obvious ones, right? So once you go into open escrow, right? If whether your borrower has already submitted an application and started as a TBD or not, right? Credit has to be run, obviously. And then once you're open escrow, you get the initial disclosures out. On that note, what has to be signed for us to, as the mortgage company, the lender, to order credit or order the appraisal? What has to be signed?
Initial disclosures.
Yep. Which one specifically, though? While that is the right answer, you should have all the disclosure signed. What specific disclosure needs to be signed? The intent to proceed. Okay. The lender needs to document that the intent to proceed has been signed in order for them to order the appraisal. Okay. When you order an appraisal, guys, you have to let your and the processing team has done a good job of this, but you have to notify our processing team, GTL processing, and all the VAs, whether it's Joanna, April, and what I'm gonna do. I thought about creating a slideshow today, but instead I'm gonna send you a document, a flow chart of all these things in an email. Okay. Which is something I am working on. So you have to email them and let them know, hey, processing team, please order the appraisal. Now, depending on the lender that you choose, there are going to be several options. Okay, one, the borrower will be required, or the borrower will receive an email requesting for the appraisal payment. Okay, or two, I think this is more on broker files where we have to collect the payment and provide them the credit authorization. And I'm gonna send these guys. I promise you, I'm gonna send all of this information to you guys. Have you seen what a credit authorization looks like? Have you ever used one just with a sign, a nod, or a shake? Okay. You guys should, if you don't have any of this, so you guys should have like a folder of different forms, like the borrower's authorization form. I have a copy of a blank lease agreement, gift letter, and then this is a credit card authorization form. It used to be industry standard where when a borrower applies, you would send this and collect the credit card information just for any, again, borrower paid fees, okay? Or POC, right? That we see it's referenced as on the CD and LE, paid outside of closing, right? You should be collecting this, okay? In any case, Do you guys know typically how much appraisal costs are? Yes or no?
900.
900. Okay. Freddie?
I don't know, maybe 600 to 900.
Yeah, there you go. Right?
750.
Yeah, typically appraisals are gonna go from maybe like 575 typically to about $700. Obviously, the bigger the house, right? Like million five versus an 800 will cost more. Condos typically can cost a little bit more. Multi-units, of course, will cost more. So just know that there's a range, but really I think the cheapest one I've seen is probably around going rate is like 575. Do note that when it is an investment property, the market rental comparables will be needed. So that will go for an additional $125, $175 as well, on top of the regular appraisal fee. Okay, so please make note of that. Again, I will provide you a document on all things that we discuss here today. Okay, so those two are the main fees that are there's just absolutely, they're going to be a requirement. It's going to be collected up front. And then there's two more other fees that potentially be collected up front. Do you guys want to take a guess as to what those are? And then, yes, I did mean this call to be a little bit more interactive, and it kind of works out as that there's only 3 loan officers here. What are the other two? Do you guys know? Have you dealt with it already? One is regarding income.
VOE.
Is it a written verification of income?
There you go. Thank you, guys. Written verification of employment, WVOE. So I'm going to give you some context, and I'm going to tell you what it is, the process like that now. Yes, in the past, especially if you worked for a bank or a direct lender, the lender will order it, right? And they will pay for it, all right? And collect that fee later. Now, past 10 to 15 years, it's different than now. Past 10 to 15 years, usually things weren't, one, it wasn't automated, okay? And two, HR personnel will just take their time to fill it out, 10, 15 minutes to fill it out. That is really no longer the case anymore, right? Companies have gotten lazier. Companies are now, quote unquote, streamlining things. And really, companies now want to monetize everything, right? Those 3 reasons. And so what we see nowadays, okay, and this was a learning curve for me too. It was a wake-up call for me too. Nowadays, you rarely do you have an HR personnel actually physically touch it, okay? 2, there's always a cost involved now, okay? And for the reason, because of number 1, because they are automating it, right? And 3, yeah, the costs are significantly higher. Okay, before a company might charge $75 to $50, $125 at most is what I was accustomed to. Okay, now VOEs can go up to about $300, $250, $225-ish, depending on the employer. Work number obviously was the main, if you will, the kind of the frontier, the pioneer of automated VOEs, the work number. It still is, but there are also other, competitors out there now. But automation is key, and the employers want to capitalize on it and monetize it, because obviously it probably costs them money. So that's something that, if you have a client that works off of variable income. Okay, so now why the WVOE? So if you have a borrower who's a nurse, let's say, okay, a nurse, and the nurse's base pay is $40 an hour, we can easily calculate that, right, guys? How much on estimate they earn. Let's just say the nurse doesn't work the 5 hours, the 20/80. Let's just say the nurse works 3 12-hour shifts, right? That's easy, right? 3 times 12 per week times 52, because there's 52 weeks. That's 1872 hours a year times 40 is this nurse earned $75,000 base pay. But you guys all know nurses don't just get work-based time, right? They get various different variable incomes, be it overtime, they'll get some type of bonus, they'll get a night differential, et cetera, et cetera, et cetera. Right, so there's a lot of variable income, and if we cannot figure out what that variable income, if we cannot qualify or figure out the variable income for qualification purposes, then our processing team will require a WVOE. Okay, Please understand that a written verification of employment will be required, okay, if you want to qualify additional variable income, okay? And yes, that is going to be an additional fee upfront for the borrower. Unless, again, you're an egregious loan officer and you want to pay for it, okay? But that will be an additional $200 to $300 fee. If you have both husband and wife, let's just say the husband is a trucker, I don't know, or he is a banker, or he is, I don't know what other, position here. Even a teacher has variable income, right? They can qualify for bonuses, perfect attendance, so on and so forth. And if we can't figure it out, and a VOE is going to be required, hey, that's double the payment now for 2 VOEs, okay? So how do you do your job as a loan officer, okay, so that you, one, don't have to potentially pay up for a VOE, and two, you don't have to go back to the borrower and say, hey, Mr. and Mrs. Borrower, because you have significant variable income, and in order for us to qualify that, we need further documentation by ordering through a VOE. We're going to need to collect about an additional $200 to $400. Instead of having that conversation, what can you as a loan officer do to be thorough before we get to that point of potentially paying more fees? So standard, you collect W-2s and pay stubs, correct? Yep, got a nod, right? W-2s and pay stubs to calculate income, correct? If you want to try and avoid the WVOE route in ordering that and try to compute the variable income on your own or with the process through the processing team, you will need to collect, okay, year-end pay stubs. And when I say year-end, I want to be very, very clear that you will need to collect the last pay stub received in the month of December, not the last pay stub that's paid, through December 31st, and it's payable or paid in the month of January, okay? But the last pay stub the borrower receives in the month of December, be it December 21 or December 22 or something like that, that's the pay stub that we will need for 2 years, okay? Do you guys know why that's the case? Anyone want to take a wild guess why we would
Is
need
Is it because you can use it to calculate the average monthly gross income?
Correct, exactly. Because your last pay stub received in the month of December will reflect, assuming that they worked the full 12 months that year, it will reflect the year-to-date variable income received, bonuses, commissions, etc., overtime, etc. And if you have 2 years of that, so in this case right now, it would be for 2024 and 2023, then our processing team can compute an average of the variable income received and hence qualify that income. Does that make sense? Any questions? Yes, no? We're good? On, Freddie? Paul?
So it's just the last pay stub, right?
Correct. The last pay stub of each year.
Okay.
Okay. Now,
Okay.
once you collect
But
that,
there's one. I think there's one other additional thing too.
Uh-huh.
I understand your point about about collecting the year end pay stub,
Uh-huh.
but there's also I think there's also that requirement to calculate the let's say for instance if you're only in the month of like say March or something like that, and you collect the pay stub, the most recent pay stub for the end of March or something like that, or a fraction thereof, then you also have to then also as I guess as a check you also calculate from January, use the total pay up to March to calculate from January to March. I'm assuming to try to use that to compare that against what you're supposed to expect.
right.
Right.
So thank you, Paul. So what Paul, I don't know if you guys understood what Paul was saying, but yes. So the reason why I didn't cover that was, right, we're going to need the most recent pay stubs anyways to justify the overtime for the recent pay. Me mentioning the year end is simply to replace in lieu of the VOE, right? Just the VOE. But yes, current, most recent. So right now, what in other words, if you took an application right now and it's a nurse and you need to qualify variable income, we're going to collect probably an October 1st or October 15th pay stub. But to qualify the variable income, what I'm saying is, yes, in addition to the October one, because we need it for the current pay, we will need to collect the 2024 December pay stub and the December 2023 pay stub to ensure that, because remember, variable income requires a 24-month history, right? So in lieu of ordering the VOE, which has a cost of $200 to $300, we can collect the pay stubs. Okay. Finally, there is a fourth one. Anyone want to guess what the fourth out of pocket? Yes, Freddie.
So before you move on to the next, with the year-end pay stub, the way I understood what you said is we can use that to before we even order a written VOE. How is that? Typically we collect W-2s and stuff, but how is that better? Is it because the year-end pay stub comes with the entire breakdown of how that income was earned?
Well, more specifically, how much of it was earned, correct?
Okay.
Right. So right, when someone applies, let's go back to the nurse. When someone applies and we got their current pay stub, and let's just say the current pay stub has overtime of $20,000. Well, let's do simple math, $12,000, right? Or let's just say, actually, okay, it's October, right? Let's use a realistic scenario. Let's say you get a pay stub marked October 1st, okay? And it has $10,000 of overtime income, okay? The reason that we would need a VOE, okay, or otherwise to qualify that overtime income is primarily because we need to verify that the borrower has been receiving that variable income for 24 months.
Consistent.
Correct, right? So if we look at the W-2, we don't know that.
Yeah.
Yes, logically, if their income on their W-2 is $100,000 and an October statement shows that they've already made about like $80,000, logically we can assume that they've been receiving the variable income, the overtime income, all of last year in 2024. But again, it's full documentation, right? We have to be able to document everything, and that's why we're requesting that pay stub, year-end pay stub, to see the breakdown of that additional variable income.
Hey, Wagner.
Yeah.
Correct me if I'm wrong, but okay. So the problem here is not necessarily the base pay, because the base pay is actually pretty consistent throughout a person's employment, except for when they like have a promotion or change job title or whatever.
Yeah.
But the problem really specifically is the overtime. Things like, for instance, the overtime and things like some people receive bonuses and stuff like that. So with overtime and bonuses, the majority of time when people work those types of jobs, they don't get consistent. They may or may not get consistent overtime and or things like bonuses, and they have a variety of other types of payment classifications. So because of that, we can't do a straightforward base pay times either hour or monthly or something like that. But if you do that, if you have received the year-end pay stubs for both 2023 and 2024, you are able to use those collected numbers to say, okay, so even though we can't, looking at the most recent pay stub, determine what that person's consistent overtime or bonus is, at least we can use the accumulated number, which goes over the 2 years, which is enough justifications for the lenders to consider that to be consistent income. Because at the end of the day, even if you were to say that somebody's overtime was that they're going to work 10 hours additional overtime every week, the lenders are going to say, well, we want to make sure that that's going to be consistent for the foreseeable future. right?
Yeah,
So
yeah. Oh, Paul, I appreciate it. Yes, you are getting very granular. That it's actually, to be honest with that, not the intent of this call or this training session. You're doing a very, very deep dive, which I do appreciate, and that can be covered for another training session. Right now, it's just a matter
yeah,
of
no
explaining.
problem.
Yeah, the
No
other
problem.
fees, out-of-pocket fees are, but on the note of VOE, just understand we're collecting a fee for the VOE. Why? Because we have to. It's for the purposes of qualifying additional income. Okay, that's really bottom line. Okay, so if Gia and Sydney and the rest of the team gives you their findings after a review, and the income is a lot less, and you're like, hey, I provide you the W-2s and a pay stub. Why is your income calculation so low? Well, because they're going off of what they have. They're going off of, they're not going off of assumptions. Okay, so they look at the pay stub. Yeah, they understand there's overtime income and bonuses, but they don't know that the borrower has been receiving this for 24 months. So they're going to exclude it from the review. And so you're going to get a review from them, a TBD review showing less income. I'm explaining to you why that is and why at that point a VOE will be required. Okay. The final one, guys. Okay. So borrower will be responsible for a credit pull. That's 108. Borrower will be, once they go into escrow, will be required to pay for the appraisal. That can range anywhere about $600 to $700. If it's an investment property, it might be around $800 to $900. Big size loans, jumbo loans. Look, don't be surprised it's $1,000 or more. Okay, that they're out of pocket. If there's variable income and we need to order the WVOE or the WVOE, the written verification of employment, understand again, the borrower may be required to pay an additional $200 to $300 per borrower for each applicant. Okay, unless again, these are all fees that you can pay for, but like the cost of tacos and burritos and eggs have gone up, the cost of doing business has gone up. I remember when credit reports, but when I first started, were $11 per applicant. Okay, at Giving Tree, it's $108. Okay, at American Financial Mortgage, the big company that I'm kind of associated with through the California Association of Mortgage Professionals, they charge $140. Okay, 108 might sound a lot, but it's not the most expensive. Believe me, guys.